Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 25th of May 2015. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. If you are viewing this video anywhere other than on our podcast channel, then please make sure that you subscribe to the Hurst Trading Room podcast channel on either iTunes or YouTube. In that way you will be notified whenever I publish a new video. Let's take a look at the markets, and we will start, as I pretty much always do, with the S&P 500. Let's find the S&P 500. Here it is. I published a blog post on Friday of last week suggesting that maybe the 80-day cycle trough, which previously I have been discussing as having occurred in the first week of April, maybe that trough in fact occurred in the first week of May. So let's discuss that for a moment and consider what the implications of that are. Here is the analysis that we've been looking at recently in the previous several videos, and there is the 80-day cycle trough. Now, I particularly like that position for the 80-day cycle trough, and there are a few reasons. I won't go through all of them now, but perhaps the biggest reason is the fact that we're seeing a pattern which is being repeated at two different time frames, and that pattern implies that that is the position for the 80-day cycle trough. I spoke about this a few weeks ago, so I won't dwell on it, but here is that pattern. You can see a move up, down, and then a sort of a triangle pattern that develops over there, with the 20-week cycle trough over there, and then a similar pattern which basically repeats itself, but over a shorter time frame, and that is again a strong move up, move down, and then a sort of a triangle which ends at this point over here, and that makes a lot of sense to me as a sort of a fractal. It's not a perfect fractal, but it's a repeating pattern over two different time frames. And so it makes sense to me that if this is a 20-week cycle, as I believe it is, 20-week, then we would probably see the same pattern playing out over a complete iteration of one of our cycles, such as in this case, I believe, an 80-day cycle. But of course, it is possible that that might not have been an 80-day cycle, that might have been a 40-day cycle. So let me just clear all of this and let's have a look at that. Let's count some bars so that you can see what the possibilities are. That 20-week cycle occurred in 110 days. You can see that number 110, or 15.7 weeks. So it's a short 20-week cycle, because of course the average length of a 20-week cycle is 136 days. And if any of this stuff confuses you, please make sure that you go and take a look at the videos in the Academy which explain all of these basic details. So the average length of a 20-week cycle is 136 it's 136 days, not 136 cycles. 136 days. 110 days is short for a 20-week cycle. If we then measure the bars from that trough to this trough over here, you will see there are 63 days, 63 bars. Now, the average length of an 80-day cycle is 68 days. And so therefore, this is also possibly a slightly short 80-day cycle. Now, that looked very good to me, and I've spent several weeks speaking about that trough as being a trough of the 80-day cycle. How is it possible that that could be a trough of the 40-day cycle? Well, let's zoom in and we can discuss why that is. Let me press the right button here to zoom in, turn that off. Okay. You will notice that there are several potential price lows around about this area over here. There's a price low over there, there's a price low there, and there's a price low there. several potential candidates for the actual formation of the price trough. Now you can see that I have pinned the 80-day cycle trough. That's what that pin symbol means. It means that I have influenced Sentient Trader's analysis and I have pinned that trough. I have asked Sentient Trader very nicely to position that 80-day cycle trough there if it possibly can, and it has obliged and positioned that 80-day cycle trough there. The reason that I have done that is because it's at 63 days, as we have already determined, and the previous moves down to potential troughs were really sort of intraday or very short-lived spikes, as you can see. Let me clear that so that you can see it more clearly, and you can see that on this bar over here we had a candle with a very long tail to the downside, which indicates that price sort of spiked downwards in the middle of that day and then closed the day back up again, and we had another spike down over here. Now, of course, those could be the low points of the 40-day cycle, the point at which the cycle forms a trough. They could be. Personally, I prefer to see the body of a candle reach all the way down, if possible. It's not always possible, of course, but that is why I favor the trough in this particular position. That was immediately after the Easter weekend. Of course, that could have been volatility surrounding the Easter weekend. So again, these candles can be a little bit deceptive. It's quite possible that before the Easter weekend, in very thin trading on Good Friday, the market dropped down to a low point. It opened at the low point on Easter Monday, and and jumped up again quickly. So that was potentially also simply a spike downwards. So the exact position of that cycle trough could be debated at some length. The honest answer is that it's very difficult to tell exactly where that cycle trough should be positioned. So that is why it is possible that the 40-day cycle formed somewhere, round about here. Perhaps the 40-day cycle did occur over here in the second week of March. That certainly would seem to make sense. But perhaps the 40-day cycle was long and it occurred towards the end of March. The big difference for us is what the meaning is, or what the magnitude is of this trough here in the first week of May. Now, according to this analysis, you can see, which is the analysis I've been discussing for several weeks now, according to this analysis, that trough in the first week of May is a trough of the 40-day cycle. There it is. That's the 40-day cycle trough marker. Now, that still looks very good. It's really a very good, valid analysis. There's nothing wrong with it. And if we look at the interactions between price and the FLD, you will see here is our A category interaction as price broke up above the FLD. Here is B, very good B category interaction as price came down to the FLD, tracked along the FLD, broke back up again in the C category interaction. Here's the D category interaction where price broke down below the FLD, a little bit messy as it came back up to the FLD, but then it completed its move down at the point at which it formed its 40-day cycle trough. Here is the E category interaction the very next day as price broke back up above the FLD. And again, a little bit of messiness surrounding that interaction. Price tracked along the FLD for 3 days and potentially over a weekend, and so a little bit messy, but nevertheless a valid E category interaction. And of course the next interaction that we are seeing is the F category interaction. Now the F category interaction should give us a good short trade, but before we jump into that short trade, we need to consider this trading opportunity carefully, which is why it's important that we are confident about the magnitude of the trough at the beginning of May, this trough over here. If it is a 40-day cycle trough, then we are looking at an F category short trade, which is upon us now, and we would be looking at making a good profit as price comes down into this nest of lows here, which is of course the nest of lows for the 40-week cycle trough. So we're expecting all stock markets, in fact, and we'll take a look at some other stock markets around the world in a minute. We're expecting all stock markets to form a 40-week cycle trough fairly soon. According to this analysis, it is expected early in June, as you can see. But there's some subtleties that are worth speaking about. Can you see the circles that form the circle and whiskers? Remember that, of course, we call these circle and whiskers. The circle is the exact day or bar upon which the next trough of a particular cycle is expected, and to each side of that circle is the range of time, and the combination of the circle and the lines to each side we call the circle and whiskers. You can see a very neat arrangement of circle and whiskers for the 80-day, the 40-day, the 20-day, and then of course the 10-day and the 5-day cycle troughs over there in the first week of June. But where are the circles for the 20-week and the 40-week? Well, we actually need to zoom out to see. Let me just zoom back again. We need to zoom out to see the circles for the 20-week and the 40-week troughs, and here they are. They are displaced. Can you see? So the 40-week cycle trough, of course, needs to be a synchronized trough. The 40-week cycle trough will occur at the same time as the 20-week cycle trough and the 80-day cycle trough and the 40-day, 20-day, 10-day, and 5-day. So we have a staggered nest of lows there. According to this analysis, of course, we would be entering into an F category short trade now for the move down into the 40-week cycle trough, which is expected pretty much in the first week of June. However, the 20-week and the 40-week cycle troughs are actually expected a little bit later, around about the middle of July. So perhaps it is a little premature for us to be getting into this F category short trade. And let's have a look at the alternate analysis that I discussed in the blog over the weekend, which considers the possibility that the 80-day cycle trough occurred in the first week of May. So here you can see our analysis is pretty much the same up until early May, because there is our 20-week cycle trough in the last week of, it's the first week of February, I believe. That's the 20-week cycle trough. And so what this analysis is telling us is that the market action that we have seen since then completed an 80-day cycle, with the 80-day cycle trough here in the first week of May, as opposed to the 80-day cycle occurring about a month earlier in the first week of April. So this is a perfectly possible analysis. We could spend a lot of time speaking about some of the subtleties, but I don't want to spend too much time discussing it because I have several other things that I would like to look at in today's video. But take a look at my blog post on the Sentient Trader website and on the Hurst Cycles website, where I discuss the possibilities. One of the things that is worth noting about this analysis is that if we measure the length of the cycles, and of course we've already done that here with the 20-week cycle, that's 110 days, as I've mentioned. It's a short 20-week cycle. However, if we then measure this 80-day cycle, that's 94 days. So that's a long 80-day cycle. Now, when cycles change from being short to being long, that generally tells us that the underlying trend, the cycles are longer than the cycles that we're measuring, have turned from bullish to bearish, or perhaps they've turned from very bullish to less bullish. But there's certainly a shift in the underlying trend. So if this is the correct analysis, it is yet another indication that the longer cycles are turning down, and our underlying trend is turning from being very bullish. It has been very bullish for some years. It's turning from being bullish to being certainly less bullish, or the bull is beginning to lose its strength. Now, let me press the right button again. Okay, so what is the big difference with this analysis in terms of the trading decision that we're going to make? Well, let me zoom in and show you what the big difference is. Highlight that FLD. There we go. We trade the interaction between price and the FLD, and as I've already indicated, we had a fairly good sequence of interactions between price and FLD playing out from the trough at the beginning of April. But if the 80-day cycle trough occurred the first week of May, then we have a different interaction that is taking place. And I spoke about this in my previous video, but here is the A category interaction. Okay, and as we can see, here's the distance between the pivot point or the cycle trough, the 80-day cycle trough, and the crossing point of the FLD, the point at which price crossed the FLD. You can see that price, by achieving new highs last week, almost achieved its target. Its target is actually off my chart. It's above my chart. My target would be somewhere around about 2140, I believe, so something like that. And so the target is actually off the chart. And so our price move has not yet achieved the target for the A category interaction. But our next interaction is, of course, the B category interaction, which is expected to occur round about the position of the 20-day cycle trough. Now, there have been 18 bars or 18 days since the 80-day cycle trough at the beginning of May, and the average length of the 20-day cycle is, as you should know, 17 days. And you can see the recent average length of our 20-day cycle down here in the corner of the chart is 17.2 days. So we are right at where we're expecting the 20-day cycle trough to occur. And if this analysis is correct, then we would expect price to come down to the 20-day cycle, FLD, and find support at the FLD and track along that FLD. So in other words, we would not want to be entering a short trade at the level of the FLD. How do we deal with the fact that there are two possibilities in terms of this analysis? The one possibility is for an F category short trade, and the other possibility is for a B category interaction, which I would not want to trade. In other words, I would not want to enter short. Well, fortunately, there is a solution. There are two or three possible approaches. One possible approach is that you study the charts very determinedly, and you decide which analysis you believe is correct, and you trade on the basis of that analysis. That's one approach, and we'll take a look at some of the other markets in a moment to see which analysis is likely to be the correct one, because of course the principle of commonality tells us that stock markets tend to move with a great deal in common. And so if the analysis in many different but correlated markets or connected markets, related markets, if they tend to be the same, then we might be able to reach a final conviction in terms of what the correct analysis is. But the other approach, and the approach that I favor actually, is to keep in mind both possibilities. So I am interested in entering into a short F category trade, but I don't want to accidentally enter into a short B category trade. So how will I do that personally? You might have your own approach, but this is what I do. I am going to be watching the FLD very carefully, and as price comes down to this FLD, I'm not going to enter the trade at the level of the FLD. That's the first important thing. The other thing is that last week we saw a low point on Thursday, and we saw a low point earlier on Monday. Now, I would not enter at the level of the FLD if it touched there today. Today is, of course, also a holiday in the United States, although the markets are open. They closed slightly earlier today, but there is trading happening. As you can see, there's a bar forming on my chart over there. So I would not enter at the level of the FLD because I think that would be just a little too aggressive. I'm not that convinced about the interaction that is coming next. I would possibly set an entry level at the level of Thursday's low or a few ticks below it. Or if you're feeling even slightly more cautious, then I would set an entry level at the level of Monday's low, last Monday's low. So that's just about 2110. Now, why can I afford to set my entry level so far below the level of the FLD? Well, because if price does get down there, then that would increase the chances that an F category interaction was playing out. And F category interactions usually are very good, profitable interactions. So that's the approach that I would take if I cannot reach a decision about which analysis I think is the most likely. How could I reach a decision? In the S&P 500, it looks very much 50-50. It looks good with the 40-day cycle trough in the first week of May, and looks like the F category interactions coming next. And it also looks good with the 80-day cycle trough in the first week of May, so it's very difficult to choose between them. Let's take a look at some other markets. Here is the Dow, and notice that there are no pins at the foot of the chart. Well, no, I beg your pardon, there is one pin, which is the pin for the 18-month cycle trough over here. All that means is that I've told Sentient Trader that that should be an 18-month cycle trough as opposed to a 40-week cycle trough. We won't dwell on that now. But my point is that I haven't pinned the 40-day cycle trough over here. I haven't pinned the 80-day cycle trough over there, or the 20-week cycle trough. So Sentient Trader has performed this analysis entirely on its own. Sentient Trader, I must say, to be absolutely honest, is a better analyst than me. It's been humbling, but it's true. So when I see an analysis that has not been influenced by me, that gives me increased confidence in the analysis usually. We also have a very good, very neat nest of lows for the 40-week cycle trough over here. As you can see, they're all in line. We don't have the displaced 20-week and 40-week cycle circle and whiskers. A very nice, neat nest of lows. That indicates that the 40-week cycle trough is expected probably only in mid-July. And that it increases my confidence in the fact that the 80-day cycle trough occurred in the first week of May. So this is one extra point, if you like, one extra star for the fact that we should wait and not jump into a short trade right now. Let's just zoom in here quickly and take a look at our 20-day FLD. You can see that price has come down already in overnight trading. I'm recording this video in the morning in Europe, and so this is overnight trading that you're seeing in this bar over here. It's already come down to the FLD. I didn't jump into it because I never do on a Monday. Jump into a trade when price comes down to the level of the FLD in overnight trading. Very dangerous thing to do in my opinion. Here are the lows from last week. To be honest, I would be very careful of entering into a trade even at the level of those lows. I might, if I was feeling a little bit aggressive about this trade, might set an entry level a little bit further down in the hopes of catching an F category short trade. But I have to tell you that things are looking good for the position of the 80-day cycle trough over here. You must remember that performing a Hurst cycles analysis is an art as much as it is a science. Trading using Hurst cycles is an art. It's something you need to develop some experience at doing. And so we have two possibilities. The one indicates a good, profitable short trade moving down the F category. The B category indicates that the market's going to find support around about this level and bounce up again, perhaps even reach new highs yet again before coming down. The fact that there are those two possibilities cautions us to be careful of jumping into one or other of those trades, but in particular jumping into that short trade, particularly on a day that is a holiday in the United States and trading is likely to be fairly thin on the ground. So I'm certainly advising caution, and personally in my trading I'm going to take a little step back. I'm not going to jump into a short trade just yet. But let's take a look at some more markets and see if we can strengthen our confidence in either of these two possible analyses. Here is the NASDAQ. Now the NASDAQ gives us a point in favor of the other analysis. Why? Well, because here is the 20-week cycle trough. You can see the NASDAQ dropped down a little bit lower. Now the 20-week cycle trough, you will remember, was at the beginning of February in the S&P 500 and in the Dow. In the NASDAQ, the 20-week cycle trough occurred a good 2 or 3 weeks earlier, although that might have just simply been an overnight spike. So we should consider that with a little bit of skepticism. But here is the 80-day cycle trough over the Easter weekend, which of course was one of our analyses in the S&P 500. And here is a very good, neat 40-day cycle trough in the first week of May. So this analysis looks good, and it is clearly an analysis which is in favor of the F category interaction happening next. Let's have a look at our interactions here. Here is our A category interaction. Very good, valid A category interaction. Achieved its target and surpassed it a little bit in terms of reaching this peak over here. Here's the B category interaction. Notice how price came down and straddled the FLD, finding support at the level of the FLD. Remember, the FLD doesn't need to be at the low of the bar. FLDs are based upon median price, and so price will often drop down below the FLD, but it will straddle the FLD, which is what it often does between the B and C category interactions, and it did over here. It straddled it on the Friday, and then on the Monday, and then it took off and climbed up above the FLD. That's the C category interaction. There's our D category interaction, broke down again, bit of a pull back to the FLD, nothing unusual about that. Here's the 40-day cycle trough. Here is the E category interaction as price broke up above the FLD again. Bit of a messy interaction because it broke up above it and then tracked along it, but then went clear above it. And so, of course, we're expecting the F category interaction next. So this analysis gives a point or a star towards the analysis that expects the F category interaction next. So we have still a bit of a balance, an unresolved situation. Let's take a look at the DAX. It's often very interesting and useful to look across the oceans, look at a European market perhaps, and see which analysis seems to be the most likely analysis in Europe, because these markets, while they won't have exactly the same analysis, they will often have a great deal in common. Now the DAX, as you can see, went through a period of extraordinary sort of distortion where all the cycles were squashed because of what was, in my opinion, a good deal of fundamental interaction. There's been a lot happening in Europe in the news, particularly over this period. There were the Greek elections. There's the whole debate about whether Greece is going to remain part of the euro or not. That is still ongoing, of course. Tremendous number of things that happened in this period of time, from the beginning of 2015 up towards the end of March, although of course they are still happening, in terms of debating the future of Europe as an economic power, and Germany particularly, and so on. So a lot of that interaction, I believe, causes the cycles to become a little bit distorted and makes the analysis a little bit tricky. But we have nevertheless a very good analysis over here. The only thing that's slightly surprising about this analysis is that the 20-week cycle trough, which occurred towards the beginning of February, you can see in the DAX, only came down for about a week, as you can see. Now, that is unusual, yes, but not impossible. It's very important to remember that a 20-week cycle does not necessarily cause price to go up for 10 weeks and come down for 10 weeks. It's a very important misconception about cycles and markets. And the way in which the cycles combine, they can often be distorted, particularly when there are news events that are happening to contribute towards the distortion of cycles. And so, although that is an unusual 20-week cycle trough, it is by no means an impossible 20-week cycle trough. And so this analysis is good and valid. And do you notice the really important thing about this analysis? There is the 80-day cycle trough in the first week of May. So this analysis, in my opinion, shifts the balance in terms of choosing which is the correct analysis. It shifts the balance in favor of the fact that the 80-day cycle trough formed in the first week of May. In my opinion, this analysis is the final straw on the camel's back, which tips the scales and tells us that it is more likely that the 80-day cycle trough formed at the beginning of May. For that reason, I will be waiting before I jump into my short F category trade. But if we do see some strong bearishness happening now, starting to build up, then of course the F category short trade might still be a viable option now, but I certainly won't be jumping in at the level of the FLD. Let me quickly take a look at the euro to US dollar and discuss what has been happening there. Of course, I've spent many videos speaking about the magnitude of this trough here in the middle of March, which I was expecting to be a very high magnitude trough. We had a fairly neutral shaped 40-day cycle. You can see that's a very neutral shaped cycle, and it was a 40-day cycle which developed after that, and I wrote some blog posts about how a neutral cycle does not mean that this is not the start of a very big bull run, and it does not disqualify this trough as being a trough of a very high magnitude cycle. And so this analysis looks very good for me. After the formation of the 40-day cycle trough, the bull really started kicking in, and that happens really often. Very often I see a very big magnitude cycle trough happening, and I'm not just speaking about end-of-day charts, I'm speaking about in intraday charts. You get a trough of 20-day or 40-day cycle magnitude. For the first few hours following the formation of that trough, you get very neutral shaped cycles, and then suddenly the bull seems to catch up, and we get a really bullish shape. So this is not unusual in my opinion. And so there is the next 40-day cycle. We have really good, nice interactions, A, B, C, D, E, and of course the F category interaction which occurred last week. I was speaking about expecting that F category interaction, and now of course we are looking at price coming down into the 80-day cycle trough. Here's our nest of lows. The 80-day cycle trough in the euro is expected around about now, so it could happen any time soon. And then of course we would expect to see price break up above the FLD. Be a little careful of price coming up to the FLD for a G category interaction followed by an H category interaction before the A category interaction occurs. Be a little careful of that, although it is possible that G and H interaction occurred at the end of last week. If I clear this and zoom in here, you can see how price broke down below the FLD over here, and then came up, touched the FLD, and then came down again. That's a really typical GH category interaction. So I would certainly be looking at going long for the next interaction between the euro and the euro US dollar forex pair, I should say, and the FLD. I would like to quickly speak a bit about the British pound to US dollar. This isn't an instrument I've spoken about before, but I feel it really deserves some mention in today's video because of the absolutely perfect example of interactions between price and the FLD. I'm not going to look at the long-term analysis or spend a long time discussing this, but here is the 18-month cycle trough, or potentially even longer, but let's call it the 18-month cycle trough for now, which occurred here in the middle of April. Now, the long cycle trough in the euro to US dollar occurred, in my opinion, in the middle of March, so there's an interesting slight discrepancy between these two analyses. But take a look at what happened in terms of interaction between price and the FLD. This is a real textbook interaction, and I must say the British pound to US dollar is a fantastic instrument to trade using the FLD trading strategy, because the number of textbook examples that I have found in the British pound to US dollar is many. So here we go. Here is the A category interaction. Now, what do we expect from an A category interaction? We expect the target to be fulfilled and often surpassed. So there is the level of the interaction at about 1.49. Here is our initial stop loss or our pivot point, the level of the previous 80-day cycle trough. and we can simply count the grid lines. That's 1, 2, 3 and a little bit, and count them up, 1, 2, 3 and a little bit. So our target would have been somewhere over here. That's our T2 target. I can't even write a 2 with this pen. There we go, T2. So you can see our A category target was achieved and it was surpassed. That is a typical A category interaction, following which we expect price to come down to the level of the FLD where it will find support, and that is the B category interaction. And look at this perfect textbook example of a B category interaction. Price came down to the FLD round about the formation of the 20-day cycle trough. There's the 20-day cycle trough. At round about the point at which the 20-day cycle trough is forming in the market, we see price coming down to the FLD and finding support at the level of the FLD. That is exactly what it did, with a great deal of accuracy. Following that, price bounces back up from the FLD again. That is the C category interaction. There it is, C category interaction. Price bounces back up again. Let me come back to the C category interaction in a moment and show you some further detail about the C category interaction. But what happens after the C category interaction? We expect a D category interaction where price will drop down below the FLD as it comes down to form the 40-day cycle trough. Now there's the nest of lows for the 40-day cycle trough. The 40-day cycle trough is expected round about now, and in fact last week on, what was that, Tuesday, it looked possible that the 40-day cycle trough had formed last week on Tuesday, and price was already bouncing up again, although it had formed at a level above the level of the 20-day FLD. So let me speak about that for a moment, because I did have some people email me saying what's happening in the British pound US dollar. Has the 40-day cycle trough formed? And we haven't yet seen the D category interaction. And now it's a good question, because of course we expect the D category interaction to occur as a price cross, and we expect to see price crossing below the FLD. And of course now price has crossed down below the FLD. It did it on Friday. The actual price level at which the price cross occurred was right down over here, round about 154.9, something like that. But of course you have to remember that after price has crossed the FLD, we have to recalculate, or we have to calculate the exact level at which the median price did cross. So let's take a look at our median price chart. There you can see the actual level of the price cross was up here at around about the level of about 155,600, something like that. That's the actual level at which the median price crossed the FLD. That is the critical level. Okay, so very roughly we can work out the target for this D category price cross below the FLD. Here's our high point at about a level of 158, 100, something like that. Here's the level of our price cross, the level of the median price cross, and the level of our target is somewhere down here, and we could calculate it exactly, but it's somewhere around about 153. Okay, that's the level of 153. That's roughly our target. Now, usually a D category interaction achieves its target very accurately and then bounces back up again. In other words, we expect price to come down to the level of about 153 and then bounce back up again. But it's very important to bear in mind the other things that are happening in the market, and in particular the other cycles. The underlying trend at the moment is really very bullish, because the 18-month cycle is going up, the 40-week cycle is going up, the 20-week cycle is going up, and the 80-day cycle, well, it's busy topping, so it's going about level at the moment. But that means that we have quite a lot of bullish pressure at the moment. I would therefore not be surprised to see this D category target to the downside not even being reached, not being fulfilled. So I am standing by to enter into an E category long trade when price next crosses up above the 20-day FLD, and I would not be disappointed to see, or not be surprised to see, the fact that the D category short target is not reached, not fulfilled by the price move downwards into the 40-day cycle trough. The 40-day cycle trough really needs to form quite soon, and so I don't expect to see a tremendous amount of downwards movement here in the British pound to US dollar. So I will be looking for a bounce back up again. So it's useful and important to think about those details. So when I was asked last week, is it possible that the 40-day cycle trough has formed on Tuesday above the level of the FLD? The honest answer was yes, it is possible, because there is a lot of bullishness in the market. It is possible that the 40-day cycle trough has formed above the level of the FLD. I must say that doesn't happen very often. Most often the 40-day cycle trough occurs below the level of the 20-day FLD, of course, because we get our D category interaction. But it is possible, and it was possible yesterday. So if you missed that short trade, as I did, I'll be honest, I missed that short D category trade because I thought that the 40-day cycle trough had probably formed. It was a missed opportunity, but not a losing trade, so I don't mind missing opportunities because there are always more opportunities around the corner. Now, I mentioned a moment ago that I would speak about the entering into the C category trade. This video is already very long, but there's an important lesson to be learned here. There's our A category trade. A category trades are usually fairly easy to enter into, although an important point to bear in mind with an A category trade is that they always occur when everybody else is feeling really bearish. Okay, everybody else is saying, oh no, the market's going to keep moving down. That's when you need to be entering into your A category trades, because they happen round about the turn of an 80-day cycle at least. This was an 18-month cycle. So it was a really strong turn. Many people were feeling very bearish at that time. They were saying, no, the British pound US dollar, is still going to keep going down. But that would have been a good point to enter into the A category trade. The B category, of course, we don't trade. We don't enter into a short trade of the B category because we expect price to come down to the FLD and then to track along it. Now, how can you get into a C category trade? The C category trade occurs when price pulls back away from the FLD. They're very good, profitable trades, but do you notice that price is not below the FLD? And most of the time, price does not get below the FLD for entering into the C category trade. So, how do you get into that very good, profitable C category trade? Well, you use the 10-day FLD, and that is why on the Hurst signals charts, on the 6-week view, you see the 10-day FLD as well as the 20-day FLD. There is the 10-day FLD, and the 10-day FLD is very useful for entering into C category trades, also H category trades, but I won't dwell on that for now. What very often happens is that price enters into what I call the bubble. I call it a bubble because it always looks a little bit like a bubble that forms between the 10-day and the 20-day FLD. And when price comes down to form the 20-day cycle trough, it very often enters into this bubble. Can you see? It entered into the bubble, and it touched the lower level of the bubble, which is of course the 20-day FLD. And at that point, you can start using the 10-day FLD as your entry level. If we had used the 10-day FLD as your entry level here, then we would have made a very good entry into this long C category trade. Now, if you are just learning about the FLD trading strategy, then I would not recommend you do this, because it requires nerves of steel, and it requires some fairly solid experience at trading the interaction between price and the FLD. But if you are more advanced in trading the FLD trading strategy, then you will know that, of course, an entry at the level of the 10-day FLD is a very good way of getting into a C category trade. But you really need to know what you are doing. One of the great advantages of this is that your stop loss is often fairly close. It's much closer than the distance generally between the 20-day FLD and the level of the pivot point for the A category trade, for instance. C category trades usually have much smaller distance between the entry level and the stop loss level, the level at which you would exit. Thank you very much for joining me in the Hurst trading room today. I wish you profitable trading and look forward to seeing you next time.